Hello class, my name is Amy Hartoon and Molly Connor is my group member and we're here to talk to you about PepsiCo. We will be discussing their corporate strategy, their long-term attractiveness scores as evaluated by us, their competitive strengths, their strength matrix, an overall evaluation of their current business strategy, their strategic and resource fit, a financial analysis of the numbers that we were given, and finally, recommendations that we have for them that will hopefully boost productivity, revenues, and make them an even more competitively viable company. PepsiCo has several different strategies that have helped them become the largest snack and beverage company over the past several years. The strategy that PepsiCo uses best is the broad differentiation strategy. Since it is a snack and beverage company, it appeals to everyone because it offers a wide variety of snacks and beverages that can range from healthy to unhealthy, such as Sun Chips and Tropicana to Lay's potato chips and Mountain Dew, depending on what you crave at the time. The other strategy that PepsiCo implements well is the low-cost provider strategy. All of the snacks and beverages that PepsiCo produces have low costs. These low costs appeal to all kinds of customers since the prices are so reasonable and affordable. On top of these main two strategies, PepsiCo also focuses on product innovation and international expansion, which helps out their market greatly. The long-term attractiveness of PepsiCo is in a very good place business-wise. The Frito-Lay industry and the PepsiCo beverage industry are the two main moneymakers. These two segments bring in the most revenue and are the most popular. Quaker Foods is the smallest moneymaker, but it is still in good shape because it has steady revenue of the past few years. The Latin American food segment is doing increasingly well since the revenue has significantly increased the last 2 years. Europe is the third largest source of revenue for PepsiCo, and their revenues keep increasing as well. Finally, the Asia, Middle East, Africa industry has been slowly decreasing over the last couple of years. The two most competitive industries of PepsiCo are the Frito-Lay snack segment and the PepsiCo beverages segment. These two industries bring in the most money and are the most competitive out of all the industries. Quaker Foods is the least competitive industry, with Asia, Middle East, and Africa not too far behind. This table shows the rankings for the competitiveness of each of the industries, and overall PepsiCo is a pretty competitive business. This strength matrix shows the industry attractiveness scores compared to the competitive strength scores. As you can see, PepsiCo beverages and Frito-Lay are both very attractive and have high competitive strength. Europe is not too far behind them either in the matrix. Latin America and Asia, Middle East, and Africa are close in their rankings also, and then Quaker Foods would be the least attractive and weakest industry of them all. Quaker Oats is still steady in their revenue, but PepsiCo beverages and Frito-Lay just happen to make more sales, and they are more attractive in the industry. PepsiCo has done incredibly well with its different business segments working as a diversified company. All of the different industries work well together. The Frito-Lay and PepsiCo beverage industries are the top industries in PepsiCo, and they work well together as well as individually. Since the company is primarily just a snack and beverage company, it has a very good resource fit because they are able to use the same resources for their products, and it saves them money. The strategic fit is exceptional because the products can sell together. Overall, PepsiCo has been doing very well in their food and beverage sales. PepsiCo is in a good position to keep generating more revenue in the upcoming years, and their strategy is doing well also. The strategy to sell these products together is genius because when somebody wants a snack and a drink, PepsiCo offers both. The company's shareholders should be able to receive an above-average market return. PepsiCo is doing well, and it needs to keep the productivity and sales up, and it will be fine. And now we'll move on to the financial analysis. Looking at Exhibit 1, everything seems to be growing and increasing in a good way for PepsiCo. Their net income is at an all-time high, and their net income per share fluctuates a bit from year to year, but $4.37 seems to be the highest yet for the company. With all of these numbers increasing, they are not immune to their debt increasing as well, and that's what we're seeing in the long-term debt category, which is usually bank loans and mortgage bonds, which have maturities for longer than a year. With all of their growth and expansion, we have to expect to see loans and mortgages, or else there'd be no growth. Moving on to Exhibit 2, it's a graph that shows the rise and fall of the stock prices year over year, as well as a comparison to all those stock within the S&P 500. We can see in the first graph that the stock prices are steadily climbing until the stock market crash of 2008, but no one was really immune. Around 2010, it started to climb again, and it is currently at an all-time high. In the second graph, we can see that, with the exception of a couple of individual points, the stock price for PepsiCo sits above the S&P 500 prices. Moving to Exhibit 3, we are looking at the consolidated statements of income from 2011 to 2013. Net revenues did take a dip from 2011 to 2013, and it did increase, but it is still $89 million short from 2011's net revenue. On the plus side, the cost of sales has decreased from year to year. Their interest expenses are up by $6 million, their amortization is down $9 million from 2012, their operating profits are up as well $593 million from 2012. We are seeing a net income per share and cash dividends per share increase, which means more money back to the stockholders, which will only get more and more support the more successful they are through the coming years. Looking at Exhibit 4, which shows the consolidated balance sheets for 2012 and 2013, the total current assets are higher in 2013 than 2012, and their liabilities and owner's equity is higher as well. It seems as though PepsiCo is on the verge of peaking, and they need to be sure that they can sustain this success year over year. Whatever they have been doing up to this point has been a succession of correct moves, but if they stay stagnant and don't come up with new ideas or strategic moves, they will soon be on the other side of the peak. Looking now at Exhibit 5, which shows the net cash provided by PepsiCo's operating activities from 2011 to 2013. Overall, PepsiCo's free cash flow has increased by around $2 billion from both 2012 and 2011, which shows that they have more capital to use. Their net cash provided by operating activities has also increased by around $1 billion, which is an indicator that the company is definitely doing well as compared to previous year's performance and presumably to other companies in the food and beverage snack industry as well. Exhibit 7 shows select financial data from 2011 to 2013. PepsiCo America Beverages produces the most revenue out of all the segments, and then Frito-Lay North America and Frito-Lay Europe follow behind. Quaker Foods definitely has the lowest net revenues and the least amount of operating profit, but they also have the least amount of capital expenditures, so it still remains a viable segment. PepsiCo America Beverages also holds the highest amount of total assets, followed by Europe, but there is around an $11 billion gap in 2013, 2012, and 2011. PepsiCo America's Beverages also holds the highest depreciation and amortization out of all the segments, but that is just because they hold the most assets, and they go hand in hand. PepsiCo seriously needs to consider acquiring Dr. Pepper and Snapple if possible, which held a market share of 8.9% in 2013. If they were able to absorb that portion of the market share, they could possibly hold a share around 33%, giving them the highest portion of market share for the beverage industry. They could also designate a fixed percentage of dividend distribution. Some years it might be a little more than they would have planned, some years it may be a little less, but that could potentially attract more investors that are less comfortable with blindly investing, giving them more free capital to work with throughout the fiscal year. Since there is an ever-increasing trend towards healthy and organic eating, it might be in PepsiCo's best interest to start replacing some of the staple recipes with healthier ingredients, but not sacrificing on overall taste. That being said, it is not an invitation to start using more chemical additives and artificial sweeteners that are, quote, good for you in the short run, but using more natural ingredients to keep up with demand and to attract customers who before would have never considered trying your products because of their unhealthy ingredients. There seems to be a smaller number of plants and distribution centers in Europe and Asia, so increasing the number of locations throughout the world would definitely help the economy with more jobs, and it would help with current plants' manufacturing output and take some of the stress off of the higher output facilities, giving people a better quality of life and more time for their families and hobbies outside of work. Since PepsiCo is in most of the different segments of the food and beverage industry, they need to try and permeate them all, and that starts with moving into the alcoholic beverage industry. This doesn't mean that they necessarily have to create their own beverage, although the increasing demand for ciders and other alcoholic beverages other than beer may serve as a good introduction for a new drink. It might be beneficial to create their own personal brand of beverage, but PepsiCo could just partner with an already established company like Anheuser-Busch or Sam Adams, where some mutually beneficial agreement can be obtained. Figuring out where they're lacking in the food and beverage industry will definitely help them in pursuing different options they never even thought about, increasing the presence of PepsiCo brands and therefore increasing the market share, profits, and lessening competition. We're not saying that this will lead to total domination of the foods we eat and the drinks we drink, but keeping an open mind to new ideas and new pursuits will definitely help them from keeping with what they've been doing for years and what they know will work. Without growth, they cannot expect to remain on top and profitable. Thank you for your time.